Good afternoon, everybody, and welcome to Gary's Traders Group. This is Gary, your host. It is Monday, October the 27th, a little after 4 p.m. Eastern Standard Time. I want to thank everybody for coming on board, new as well as old. Got a lot to go over today, so I'm going to get right into it and get through the disclaimer. This webinar is for educational purposes only. I am not a licensed representative or giving any trading advice. Trading does involve risk. Make sure you know what you're doing. And always use proper money management and position sizing. These webinars are designed to educate you and further help you in those trading decisions. All right. Okay, what kind of day did we have in the market today? Let's bring this up so we can see that. Gosh, you can see we're almost a flat market today, everybody. There's a whole bunch of reasons why, I think. Let me get into the macro picture here real quick. Okay, reset Fibonacci's. On the left, all the way to the left, is the Dow Jones. In the middle is the S&P 500, and on the right is the NASDAQ. I have reset the Fibonacci's to represent a yearly growth and retracement, extensions and retracement. So it better reflects the overall macro picture. When you use shorter time frames, it doesn't necessarily include the overall big picture because you could have some big swings. And October is typically the scariest month in the market. And this one, of course, didn't disappoint us at all, as everybody can tell. Boy, she took a real tumble, didn't she? The futures, because everybody knows I trade the futures, we're trading a little bit lower. As you see down here, the ESZ4 is down, so it traded a little bit lower today. And I think that's a result of some remaining nervousness in the market. And, potentially some more volatility happening this week heading into the end of the month. We are in earnings season, everybody. We definitely have seen a major turnaround in all the indices. I still would caution people because we, could have some events that could take place that could jitter the market. Today I think investors are going to mull over to see what the Eurozone stress test did. Did it provide some good results, or was it negative? I think that'll be reflected in tomorrow's market as well as the overseas market. We of course got the Feds that are going to be talking, meeting, which could provide for some more choppy waters. I think a lot of people last week, these are daily bars, started to say risk on. Time to get froggy. Let's jump in the market. It's really, beat up a lot of great stocks, and there's a lot of good buying opportunities for the big boys, the hedge funds, the money managers, the people who buy more for longer-term investing, even the mad Kramer followers, as they would say. Not necessarily for us, though, folks, because we're traders. Some of us are longer term, some of us are shorter term. These webinars are more designed to take advantage of shorter term swings in the market that we can capitalize using seasonality and technical analysis. The VIX, let's take a look at that, continues to go down. 14.73 would be a 78.6 retracement from the high. And of course this is compared to the S&P because that's what the VIX tracks. And it just is flatlined here at the 50 extension retracement of a yearly chart. So we all have positive signs though. Let me reduce this. The Bollinger Bands and the deep trending price oscillator are all pulling up. This is still pulling down. It's away from the Bollinger Band. It's important to see that. Even though it took a little turn, but we're still in way overbought territory for the VIX. we're still in undersold territory for the S&P 500. So great time to start looking at large cap stocks. One of the old things I learned is learn or watch and get into large cap stocks towards the end of October and start getting into small cap stocks the Wednesday before Thanksgiving. Some old pearls of wisdom I learned a long time ago. So things to be aware of. So going back to our major indices, I think we're still all on a great path of going up. We still got plenty of room to grow. There's going to be some slowdowns and hiccups along the way, but we're all in a major growth, rebounding, I should say, instead of growth spurt from the October meltdown. So I think we've had our correction, and it's time to start getting into the happy season, which is Thanksgiving, Santa Claus rally, and of course Christmas. Okay, let's take a look at the shorter term picture and see what's up on the calendar for this week that could affect our trades. Again, like I said, beginning FOMC meeting could create some volatility and choppy waters. Let's watch out for that on Wednesday. And the rest is, I think, normal kind of governmental news that probably won't move the market that much. I mean, we do have jobless claims coming out on Thursday, and GDP. Those could potentially affect the market, so watch out for that on Thursday. And my alma mater's report, University of Michigan Sentiment Report, believe it or not, even though it's not considered a big red star, it does affect the market because they poll a lot of 5,000 people on what the consumer sentiment is of market direction. So these are things to be aware of on a short-term basis that could affect our trading decisions. So be aware of these things. They may not necessarily, these things the market sometimes is built in, sometimes it's not. And so when you're looking perhaps to enter a trade, keep these economic news events in mind that don't necessarily reflect the individual security you're looking to trade. They can affect the overall market from an initial standpoint of a little bit of sell-off or a buying spree, the happy or negative event, the good or bad event that takes place. So do keep those things in mind when these events do come out. Okay, couple of notable, one of the stocks I want to talk about that's coming out is Twitter. Now, unfortunately with Best Choice, by the way, news event on BCS, I've been working with Brett here, and there was a beta test executable that came out this afternoon. I was the guinea pig. There was a bug in it, and it actually just got fixed here probably about 25 minutes before this webinar, and that's the option chain. It is now working for those people who are subscribed to national data. This happens to be, on Hospira Inc. And so as you see, it pretty much populates real quick, not a lot of delay. I could type in Apple and click the option chain. And you see these little dots moving right here. It's pulling the data. And the option chain pulls up, which is kind of cool. So that's one good piece of news that I think is important for everybody to know. We've got our option chain back up. And of course Apple is growing like crazy. I can just segue into this stock real quick and look at open interest. Of course, this is for this expiration. Let's go to our November's. I'm sorry, there it is. Is that the 28th? Is that what I'm looking at? Nope, the 22nd is what I wanted. There it is. That's the third Friday in the monthly expiration. Boy, look at that right there, folks. 27,000 contracts were bought or sold, more than likely bought. Majority of traders are bullish. They don't like to short the market, with 115,000 open contracts at the 110. So if you click that and say, well, what if I chose that? What if I chose that? Unfortunately, these are not all populated. That's something Brett still has to work on. You go to the strike price of 110, and it's basically stating that if there's a $12.50 move from today's price, which if you could see it in the background, this is 20 minutes delayed, 105.22. So that's $12.50 applied to that. We're looking at about 17, almost 118. There's a 1,400% potential return based on today's Greeks, volatility, and time decay. Pretty nice return. So it's a nice tool built into Best Choice that helps you evaluate risk or reward. And generally, we like to get a 3-to-1 return on our money, or at least a 300% return. So these are things that are helpful to determine if our actions warrant putting money on the table. So the option is available, the option chain from National Data. It seems to be working. You can see in this area here is a 90% probability, of Apple going up with about a 7.1% move. Let's go to Apple real quick. I was looking at synthetics. Sorry. There's the one I'm talking about right here at the 110. A lot of short interest too. That are open contracts. But I'm kind of bullish on Apple. I think Apple's got a lot of pipeline of fantastic products. It, like everything else, has been beat down. And I'm going to repeat this. I said this in another webinar, and I think it's important for you guys to understand this. The market is really moved primarily by what Larry Williams dubbed as the commercials in the commodity industry. We call it in the institutions or the hedge funds. And these are the big boys that come in, the Blackstones of the world, and they're buying huge amounts. The Berkshire Hathaways, i.e. Warren Buffett, or somebody told me the other day, if anybody watch Shark Tank? Anybody watch the show Shark Tank on CNBC? Can I get a yes from somebody? Yeah, pretty cool show. And it's become extremely popular. It's actually created CNBC to be the #1 growing cable network in the country. Because of that show, it's just phenomenal. One of the people on there is Mark Cuban, a self-made billionaire. Recently, he went and bought a tremendous amount of Netflix, just as a heads up. Actually, I think Sonny or Brett or one of those people told me that last week, so thought I'd pass that info on to you guys. Sonny's on. He said yes. So I think that's important as well to know is when these big boys come in and they're buying huge blocks, you got to pay attention to that. That is a fundamental event. It's not technical. It's not seasonal. It's just keep your ears open. And these kind of events you should pay attention to because they're leading the pack by usually 30-plus days. They know the direction of the market, and they're going to move the market accordingly, as well as they can also sell the market down for themselves to go in and to buy cheap. Well, we know what happened to Netflix on earnings. It collapsed 100 points, creating a tremendous buying opportunity. So do keep that in mind and put that feather in your cap. Back here to Netflix, though, boy, what a lot of interest for only 51 cents on a $105 stock. And we're looking at a 7.1% move here on Best Choice. So if you take that average percent move that we expect the stock to do and apply it to the closing price, 105.11 times 1.0701 or 7.01% gives you your target price on average where you could expect the stock to go to. So it's not quite 117, 118, but it is above the 110, is it not? And we've got about 3 weeks. So now this may be a little bit premature coming in because when you look from a seasonality perspective in the beginning here of November, Apple tends to, I'm trying to see if I can find it, best rating. I can't. I have to go to best profit. There it is. It highlighted in blue. Not a great odds, folks. Only 60% probability to short. But from a probability standpoint, there is potentially more odds for it to pull back first before it starts taking its run up into December. So you can always look at linear regression. It's a very powerful tool that Best Choice has. I mean, linear regression lines is, I had a conversation with Sonny on Friday about this. It was actually, this was the first thing that Pete had developed in the program, not seasonality. Seasonality came way later. You know, seasonality over the years has been a very, very good tool. But the one thing that doesn't really change, because this is reflecting current price movement. I mean, this is really a snapshot of what's happening over the last 6 months. The stock beautifully meanders between these lines, and it's starting to pull up on a 6-month, and usually we use a 6-month time frame. And you always want to look at the extreme, 61.8. I mean, when that thing starts to pop up closer to these particular linear regressions of 90%, you know, you're getting a heads up that this stock is overbought. So if it's working its way up, we're October 27th, we still have 4 or 5 days, and this thing pulls up pretty strong, then, you know, we may want to wait. See, it's pulled up, and it's actually pulled down a little bit today. There was a change of 11 cents. So it's actually kind of flattened, plateau. It may pull back a little bit, may pull up. So, you know, use these linear regression lines as a good gauge tool to find out if it's time to really enter a stock. You can always look for higher highs, higher lows. These are good indications of change of direction of a stock on a bullish trade. And obviously the reverse, when it's sitting above the bands and we're overbought, we're having lower lows and lower highs. You see that? And see this, of course, going up. So these are things you can pay attention to along with seasonality. But, you know, you also want to be looking forward, like some of the people in this webinar had, as soon as Cuban came in and bought a bunch of Netflix, they rushed out and grabbed some. One of our members, I think Jerry, did that exact thing. So, you know, but also be aware, and there's whole systems based on following volume. Volume meaning volume of options. Volume is what is bought and sold today. Open interest is what's been bought and being held, bought or sold, and being held overnight. So these are the people that have already bought and they're holding. These are people that bought or sold today. And when you've got that kind of huge volume, folks, that happens in a day, something's up. Look for that. And when there's an inordinate amount compared to any other strike price, kind of a heads up again, somebody's coming in and buying a lot. Now, it's not a lot of money, though. You know, if this thing was $5, of course, that would be a whole different sign. But still, these are indications that you can see that helps in your decision-making process, whether this is a good option to trade. And again, that's cheap. And when we went to Best Choice, we went to the option chain. We went to that expiration and went to the what if. If the 110, now we don't have a $10 or $7.50 move, which would put us at the at what we expect based on the average move, right? But I would think a 750 move would be, gosh, if it goes from 0 to 1400 between 250 and that, I mean, we could just do the math on that, and you're looking at a really, really solid rate of return. Hopefully 3 times our money, okay? So just be aware of the pullback, okay, and when you do that. Now, another stock I was looking at, unfortunately, Best Choice can't help us other than linear regression on this, is Twitter. Twitter's coming out tomorrow after market. We don't have enough history on Twitter to be able to make a seasonal, a help with seasonality, in other words, in helping us make a decision. What we do have is linear regression. And linear regression on a 6-month, it's sitting towards the bottom of the bands, which is really, really good. Now, this is more, again, from a immediate technical analysis along with any kind of third-party information like Earnings Whisper that says 14 analysts are saying strong buy. You do have 12 that say hold. Well, they got a target of $57, 53 with Citigroup on October 21st. A lot of people are bullish actually on Twitter, but it's there's not enough seasonal history to be able to go into this and say one way or the other. Another site that I could look through. Bear with me one second, please. My apologies. Good afternoon, Gary. Hey, Jackson, I'm doing a webinar. Can I call you back? Thanks. My apologies about that. I'll turn the phone off so it doesn't ring. This is another cool site I learned for traders, for-traders.com. Kind of a neat site. You can type in any symbol. And this is all free. This is also a paid site you can become, and it gives you all sorts of other information. But what I like here is when you pull it in, it has a menu bar here, and you can click on consensus. And it'll give you a lot of good information at your fingertip. This is the consensus of a high price target versus a low price target, and the number of estimates and so forth. As you can see, Twitter's been going up. It's at 54.82 right now. And also you see kind of a temperature gauge bar right here. And the mean consensus is that they're going to outperform. Number of analysts is 36. And of course you can see from this perspective on the consensus details. So just another third-party site that helps give you confidence in making a trading decision. So let's go to the option chain. There's a bug I'm going to have to tell Brett about. And that's probably Twitter. Again, this is a beta that I've got, guys, so please forgive me. I don't want to crash the software. So let's go to Thinkorswim and pull up the option chain from there. These are November expirations. It's not a cheap option, folks. If you use just linear regression on Best Choice and said, okay, the sweet spot is between the mid and the high right up here, between 53.81 and 59.85, between here and here, for a potential retracement of the stock. Now, one of the things I do like on Twitter, and this is this symbol here. You know what? Oops. That's supposed to have been red. That's why it's not showing. There it is. This is the 49 exponential moving average. The red one is the 89. When the blue crosses the red, that's my color. Doesn't have to be yours. Very, very powerful tool that the trend has changed because these are longer term moving averages. The purple is the 200. So I have the 49s cross the 89. The 49 has crossed the 200. And price is escalating up. So between 53.81 and 59.85, I mean, we could do some math on this very simply to determine what that difference is. But I think more realistically would be to just go to an option chain and say, all right, what's the 55s going for? Well, look right here at the 50s. $3.30 on a $48 stock, it's pretty expensive. Now, I know, one of the ways to play earnings, folks, that I've never talked about is trading a straddle on it. However, you do not want to trade a straddle a day or two before. The only way to trade a straddle on an earnings, which is a good strategy because it's an unknown event. It could go up, it could go down. But it's got to move upwards significantly or it's got to move downwards significantly in order for you to make money on a straddle. But you need to buy it 2 to 3 weeks before earnings because as you get closer to the event, these premiums are all jacked up. Look at the implied volatility, folks, in the hundreds. If I close this out and say, what does January look like? It's in the 60s and 70s. So the market makers are jacking up the premium on this. Even if I went to December and I went to the 50s, that's 87 right there, 87.59%. Let's just call it 87 compared to 114. The difference in that, which is a lot, like 26%, is what these premiums are being marked up at. You don't want to do that. You want to have this to be low IV and let it run up, but you need to be able to buy these things for a fair price, which is 2 to 3 weeks before. Okay? Sorry, I'm not reading my chat bar. Somebody, I should kind of look at this thing. Twitter earnings came out. It's down 9%. Well, geez, oh, Pete's. I thought they were coming out tomorrow. That's the reason I'm talking about this. Oh, no, it was today. That's why I wanted to talk about it. Oh, boy. Yeah. Not very good, folks. So they disappointed. On to the next. I am going to, I had to pull up my chart here, so my apologies. The spreadsheet so we can take a look at things. One of the trades I was looking at, which is coming up tomorrow after market, WDC, Western Digital Corporation. Keeping it at best rating a whole zone. It's a 100%er, 13 out of 13, starting the 22nd last week sometime. But you can see that composite runs up pretty strong all the way to the end of the year. So if I change it to best profit per trade, I believe this turns into an 80% win. Well, 84.62, 11 out of 13 years. Pretty doggone strong. And you say to yourself, well, where is it at this year? Well, kind of took a bad nosedive here, I'm sure as a result of the market in October. It's pulled its way back up. And it's a really nice move. Now, you can see the date here. This was the turnaround time. If we would have got in around best choices time, would have been right here. Well, we would have made money. But again, it's not an absolute. It's an average. So it could start a little bit earlier, could start a little bit later. But it's right at the bottom of linear regression. We've got a MACD that's turned up. And this is one of Pete's favorite tools. So you got 13 out of 13 years that this thing has been 100% winner between the 22nd of October and the 5th of November with an average move of 10.46%. Wait for the option chain to pull up. Let's go to our November expiration, 11/22. Let's take a calculator out. We know what the average move is we expect of 10.46%. The stock closed at $92.95 today. I messed that up. My apologies. 92.95 times 1.1046 gives me my target price of $102.67. So we could be looking at the hundreds perhaps, which you've got some good open interest and good volume. It's pretty inexpensive, 75 by 84 cents. 1% premium would be a 92-cent option. We're looking at less than a 1%. There's the potential of the stock moving to 102. You could be more conservative and go closer to the money if you want. You can see there's a lot of open interest at the 95s, but that's pricey at 229 on a 92-cent stock. I mean, pricey is relative, folks, in the sense of, is that a lot of cash you're going to put out for, let's say, 10 contracts? Yeah, it's $2,290. But is it expensive in regards to the premium versus the stock price? Well, we like to buy cheap options, 1 to 3%. Sometimes we'll pay more. If we can pay less, the better. 3%, though, would put you at $2.70. So $2.29 is not out of whack. But if you can pay less and the stock runs to there, you're going to make a lot more money. So what if we chose that? And the stock ran up to $100. And we chose the 100 strike. So that's over an $8 move. So we're looking at, even if it went to, again, we're looking at 102. And this stock, on average, could be more, could be less. But if it goes to 100, our strike price that we choose, we're looking at a potential of 471%. You're probably looking between a $7.50 and a $10 move. You're looking at about 300% move. So that's not bad. And that's WDC, Western Digital. They are coming out tomorrow after market. Now, if you're using a 6-month chart, you look between the mid and the high. 102 just squeezes right in between, or 100 is real close. Actually, it's closer to the mid than it is the high. So that's a nice sweet spot right in between here, between this band and this band. Now, one of the things to notice also about this, though, this thing tends to be a slower mover from one extreme to the other. Here it is below the bands. It's taken 1-2 months to get above the bands. And Hubbard went sideways, and then it's taken 1-2 months to get below the band. So keep that in mind. But an earnings event, remember, can make things move real fast. So I think that's important to know. Yeah, somebody brings up there's a best profit from these areas of over 17.5%. But remember, that's also buying a little bit more time. It's not buying November. And that's the reason I bring up best profit, because you could buy some more time and go further out in time on this. I got 23% on best profit all the way to the end of the year with an 84. So, I mean, look, folks, bottom line is if you want to buy some more time, which will perhaps mitigate your profit, but if it goes against you, it won't hurt you as bad either, and that's important. When you're buying time value and you're playing the time value game more, then you're looking more, you won't feel that up and down pressure as bad when an earnings perhaps misses on forward guidance. So, I mean, you could look at a January, taking advantage of this whole run, and even the hundreds at that level, it's still less than 3% at 204. And that's, of course, if you look at that, that's where the majority of open interest is right at that level of 813 contracts. Okay? So that's a decent one to look out for. Next is American Express. They're coming out tomorrow after market as well. $12 out of 13 years, and you look at the most recent years, it's had some decent moves. So there's a 92.31% historical probability, 7.1% move. I'm sorry, this is Eagle Materials, not American Express. My apologies. It also got beat down by October, but it's working its way back. It broke above the 200 moving, which is important. You have a MACD crossover on the bottom. So if we took a look at options on this, we know there's a 7.1% move. Let's take the closing. Well, this is not the right one. Oh, yeah, this is EXP. 92.55. Gosh, that happens to be almost exactly like the price was of the last stock we looked at. 92.55 times 1.0710. $99 as a potential target. So we could be conservative and look at the 95s for between $1.15 and $1.45. If you can get the mark on that for $1.20, $1.20 on a $92.55 stock, 1.2, 1.3%, not bad. So what if it pops up 2.5, excuse me, $7.50? Well, this doesn't have it in 7.5. I wonder why. Oh, okay, because everything else is incrementally in $5 movements. So the first move is a $10 move on the 95. My goodness, it's a 274% move, so that's not bad for an inexpensive premium. So that's coming out tomorrow after market. Coach is also coming out, folks. It's a great company. I just read some negative reviews about it. See, it missed last year pretty bad, folks. So I don't know if I would look to play earnings. I did not put it on my Excel sheet, but you guys could take a look at it. Earnings are coming out. Well, it doesn't do us any good. It's tomorrow before market, so forget that. One that is also in line with Coach, I think, and caters to wealthy people is Ralph Lauren, RL. A 11 out of 13 years. Consistency. Kind of following the composite. Does this little dippity-doo here in October. sitting at the bottom of the bands. Trend is up. We have the 49 cross the 89, very important, and the 49 crossing the 200, again very important. Now we got the 89 crossing the 200, and we got price above the 200. Let's make sure it did it today. Yeah, it stayed above it today. Now also you see a half purple hash mark here. Again, this was designed for the short-term swing trading for an immediate move, but there's people that have used this program that have made a lot of money. And so for those people that don't know what that means, if you go to Program Options, Screen Colors, and you look here at short-term hash marks, when the hash mark is half light blue, there's a 75% probability it goes in that direction. When the hash mark is this magenta color, there's a 90% probability that that stock will move in that direction the next day. That's what this swing trading program was designed for, is very quick, tight swing trading moves. We also have a MACD that's crossed down here. That's real important. So we have historically an 84.62% move, 5.24%. Let's see what the options look like. $161.35. It's at $161.35. We expect a 5.24% average move. So 161.35 times 1.0524 puts me at a potential target of 169, which is right below 170. So could we stretch to the 170s? Well, when is Ralph Lauren coming out? Coming out Wednesday, the 29th, before market. So if tomorrow's a bullish day on Ralph Lauren, and boy, I got a lot of positive stuff on my charting at Thinkorswim. I've got the DPO MOBO broke out. John Person's pivot study broke out. The MOBO on the Bollinger Bands breakout. The Hull moving average turning green. So I got a lot of positive telling me this thing is in an upward trend right now. I did the Fibonacci's on this thing of where we could potentially expect retracement to based on the low and the high. Well, actually, I did from low to high to low to get the extensions. These are Fibonacci extensions. So if you think about it, folks, on average, this could be 170 tomorrow if we have a positive day, because this calculation is based on a close of 161.35. If it's up $1 tomorrow, which was up today before earnings, this will put us at over 170. And look at this right here, 169.91, 169.80. Folks, you can't get closer than that. So we're looking at a 50% potential retracement. It's what Best Choice tells us on an average move. It's what Fibonacci tells us. We got a lot of positive indicators here that's telling us this stock could go bullish. If you want to do some fundamental on it, go to Earnings Whisper. Let's see what they say. RL. Analysts. 8 say strong buy, 1 says moderate buy, only 5 say hold. They're putting target prices of between 177 and 182. So with all that said and done, the 170s for $1.65 by $1.80, you still have a delta over 20. Remember, that's one of my rules. It's got to be over 20. You got low IV compared to the following months, right? Not a lot of markup, which is important. And you got some good bullish interest out here in January as well. So that's coming out on Wednesday, the 29th before market. Let's go on to the next one. NE Noble Drilling. Again, 13 out of 14 years, 6.82% average move. Forgot what the analysts say about Noble. Well, they're saying to hold, so be cautious on that. I looked at this more from a historical, gosh, if 13 out of 14 years, there's a 92% probability. But you know, you look at this and this looks kind of ugly, doesn't it? You do have a MACD crossover and a pull-up, but everything else is looking real ugly. If you go to an option chain on that, I won't spend a lot more time on this. November's 22 is cheap, folks. Cheap, 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 cheap. I mean, you pay 21 cents. You're not going to risk a lot. So it's up to you folks on that. Do your due diligence and see what you think. Now, one of the big ones that's coming up this week, which we're all kind of waiting with bated breath, is MasterCard. And that is coming out this Thursday before market. It is a 100%er by Best Choice with good consistency over the last few years. Sitting at the bottom of the bands with a MACD turn up. Can you guys see that MACD okay? I may want to expand it a little bit. There, can you see that? And it's pulled up strong. There's going to be some resistance around this area between 74 and 75.5. There'll probably be a little bit of resistance. You can see it starting to consolidate, and it may continue to consolidate. That happens typically before earnings. Looking at an average of 11.99% move. Let's go to our November expiration. And the stock closed at $74.11 times 1.1199. Puts me at a potential target of $82. Let's call it 80s, right? Boy, guys, that's cheap. Cheap, 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 cheap. IV is down there at 22 as well. Now, does it mean you're going to stretch to the 80s? Well, use the linear regression. It's powerful. What does linear regression tell us? Linear regression tells us the 80s is stretching it, right? See? Got to slide this off the chart because when you move it, it reads the different days. So you got to slide it off the chart, up, and then your eyes have got to fall between the mid and the high. And look at the high. That's based on 6 months. Now, what if I did 3 months? Why is this phone ringing? Hold on a second. Good afternoon, Gary. Yeah, no, man, I'm doing my webinar. I got to go. Okay. That even looks worse. 1 year. Again, I'd be maybe reluctant to stretch to the 80s, folks. Let's put it that way. Going back to 6 months, maybe to be more conservative, even though we've got a good precedent historically, right? But that's based on 14 days. What if I change this to 7? And it's going to change this 11.99 and highlight this area. Change to 10.57. Not that much, folks, but it will put us underneath our target of 80. But based on linear regression, now I can get rid of all this stuff so you guys could see this better. You know, $76 is the high on a 6-month. 77. So I probably wouldn't stretch as far as that. You know, you could look at the 75s, everybody, which I put the 77s actually when I did my calculation over the weekend. It's closed a little bit higher than what it did on Friday, but that's what I actually listed as the 77s, not the 80s. I like those. And again, this pulled down a little bit today based on this close. Is that today? Yeah, it's today's. So you could play a little bit more conservative and go inwards. If you want to play it more conservative, just, you know, play the 75s. Now, if you really want to be conservative, folks, you can always do spreads. Spreads reduces your profit, but it also reduces your risk. It allows you to go closer to the money. Like you could maybe buy at the money 74s and then sell those, and you're in for $1.29. It's not that much cheaper, actually. Now, if you really feel strong about this, you can go in shorter increments, and it won't cost you as much as I guess what I'm trying to say. You could buy the 75s, sell the 77s. Now it's a $2 spread, which means you have to have at least $1 of profit. You have that at 71 cents, meaning you spend $71, you have the potential to make 129. Somebody brings up, what about looking at the Decembers? Absolutely, we can do that. I just want to give you an option on the spread, but let's take a look at Decembers. Not a lot of volume is my concern on an open interest. It's still relatively inexpensive. You could buy the 75s for $2.05. That's less than 3%. I would not stretch to the 80s. I'm just more conservative. This earnings season has been a little spotty. You could also stretch to the Januaries. And you can see the open interest. Now, January's, because you are buying time, folks, and we're counting on a froggy, happy, good season. As you see no blue lines down here. Just one. You see that down here? See this blue line down here? Somebody tell me what year that is. Quickly type it in before I tell you. Anybody tell me what year that is down here? Without looking at best choice? I almost bet my last dollar it's 08. And 08 is not an atypical year for the market. So if you removed this, saying, well, this is not normal. I mean, the market completely melted. We had people commit suicide. So if you remove that, basically no blue lines down here, which means really you've got a potential 100% if you use best profit to go all the way into January. So if you wanted to buy some time, which will again mitigate a potential miss on earnings, you won't get burned and hurt as bad. Well, actually, when you do this, it goes to it goes to the beginning of December and not to the end. That's interesting. So what I can do is I'm going to change this to July. And now you see this run right here from October all the way into December. And we still have 100%. It still only takes me out to the 9th, though, of December. We've got some years that pull back. So, Jerry, you may be onto something there. With a 17.57 move, probably your Decembers would be the best bet on MA. You know, could you stretch to the 80s for 45 by 52 cents? Whew. Mathematically, that's just from 14 days, folks, $82.99. From a mathematical standpoint, at 11.99% move, which is just using 14 days. It's not even allowing for this thing to continue to move and go up. It may pull back after a pop-up. That's natural for any type of earnings trade, you know, and people are going to be taking their profit. We're going to be taking their profit off the table, which if a lot of people suddenly take profit off the table, what happens to the stock? It naturally pulls back. And then you got other people that are going to come in and say, wow, they beat earnings. Their forward guidance is great. Hey, I'm going to buy this thing and I'm going to hold on to it for a longer term as a growth stock. So then you're going to get this pull up here, which is also 100%. Adding in another 7-8%, which creates that 17% potential move. So Jerry's onto something. Definitely December's would be something to take a look at. Or even January stretching to the, if you look at this right here, folks, there's the 80s with 13,221. And boy, you can pick that up for 1% premium. It won't give you the big pop that a front month will of November, getting closer to the money, because you got less time decay and your delta is going to explode quicker. Somebody got these. You got the Novembers for 46 cents, Jerry? Sorry, somebody's typing in. Oh, he bought Deeses. He bought Decembers. December what, 80s? Or 75s? 80s, okay. Well, he's buying time, and, you know, there's definitely something involved there. See, right now, the mid is 48 cents. The nat's 52. So you wouldn't get the mid, you'd get the nat. So you got a good price on that. All right, so that is Thursday, October the 30th, before market. Keep your eyes open for that. Let's go to a few more here before we wrap up. S&P, Sinopec, 90% probability, but look at these nice moves here in the last 4 years. Real nice consistency in percentage and point movements. S&P, they're coming out October 30th as well, before market. And you can kind of see the same thing. The composite runs all the way to the end of the year. Well, that's best profit per trade. I'm sorry, let me use, again, it's a 90%er. If I stretch this to the end of the year, it's still only a 90%er. It doesn't go here. Even though here we got an 80%er. So, you know, this thing basically runs up once again. This is 08 down here. Not an atypical year. You remove that, you only have one dip down here. I don't know what year that is. But using best profit per trade, we're looking at 7.45% move. This thing's a gapper, folks. Look at that thing, which means if it pops, it will gap. You got a MACD turnover. It is oversold big time. The high in linear regression is 99.92. Once again, we're looking for a 7.45% move. And you look at the 95s, well, that's really weird. You got a 0 bid and a 50-cent ask. What did I put on S&P? I put the 90s. Sorry. I put the November 90s. 60 by 90, so you can pick it up for 75 cents. On an $85 stock, that's 0.9 of 1%. So what if it goes from 85 to 90, $5 move, 155%, I'd take it. If you want to look at some of the, what do some of the froggy heads think about S&P? Two hold, one sell, one buy. Make your own determination on that. Oh, if you want to learn about straddles, theoptionguide.com, buying straddles into earnings. Really nice read for you guys. They talk about using that strategy of going into earnings. Theoptionsguide.com. One more I want to. There's two more I want to talk about. Well, Priceline is too soon because that's Thursday, November 6th aftermarket. But Trimble Navigation, TRMB. 81% probability based on best rating of whole zone. This thing runs 90% all the way to the end of the year with really nice movements, folks. I was looking at the November 30s. You got a MACD crossover. I know this kind of looks ugly. You got 7 buy though on that, and I did some reading on this. You could go to this 4traders.com as well. And go to consensus. These are things that I do in preparing for this, guys, and looking at the trades. Outperform is what they're saying. You can go to MSN as well and take a look at what they say. As a side, oops, TRMB. They're also outperform. Their target price is 32. I'm saying from a seasonal perspective, 12.13% move, 10 out of 11 years. That's pretty strong, 90% probability. These guys are coming out, by the way, Thursday, October 30th, aftermarket. They've done a lot of good stuff. Read up on them. They've got a lot of good products, and they're doing well right now. So do some due diligence and read up on these guys, besides just seasonality. 12.13% move at $29.61. Puts me at 33. That's stretching it. I looked at the 30s, to be honest with you. That's what I wrote down. Now, what did they do today? I guess I need to look at that because I put down November 30s. Well, they pulled up, and there's your half magenta, right? Half magenta. So, and now, remember, this looks ugly, but watch this. Let's go to linear regression. Watch this. Different picture, right? Different picture. Another strategy, just so you know, folks, I've been playing with, and I'm going to, next couple of weeks, I'm going to try this with very small amounts of money, is one of the things I put on Trimble, TRMB, for example, and I've talked about this before, is doing a back spread. Reason is you can get into it for cheap. The 22.5 by, oh, this is December. Let me go to November. You could get a credit of 40 cents, which means, folks, Here's your worst case scenario. You get paid $40 for making this trade. Okay, you expect this thing to pop. Going to perhaps $33 based on an average move. Could be more, could be less. We're financing buying to 30, I'm sorry, financing buying 232.5s by selling 130. So your worst case scenario by getting paid $40 is that you'll lose 210, but you have an infinite amount of profit. Basically, you've bought 2 at 32.50 for less price because you sold 130. Now, that's not what I did on this one. Actually, when I look at my worksheet, I did the 25.27s. This thing is up only 3.5 cents. So I did this one. Sorry, a little different. You spend 35 cents. What is that? $35. You spend $35 to get you into the 27.5s, folks. Not even the 30s. The 27.5s. We're expecting it to go to 33. So you're being able to buy 2 27.5 contracts for 35 bucks. Your worst case scenario is you lose 285. The best is this thing pops, goes to 30, and your 2 27.5s go through the roof because you got 2 contracts for only 35 bucks. So I'm looking at doing those kind of things and not risking a lot of capital. See how they work out on a good pop. Because I've done a lot of back testing on this, and there's no doubt when you got a big pop on this and you buy these things right, these are fantastic to pay when you're looking for a gap up and a big move on a stock. Okay, I'm going to leave it at that, folks. Is there any stocks you guys want me to look at real quick before we go? Gary, did you mean Sina or SNP? You know, that's a good question. Gosh darn it. I hope I didn't put down the wrong one. Well, looks like Sina's coming out too, but no, I didn't like what their seasonal was. And you know what? Look down here. This is important to learn, Leon. Look at this. When you got your best choice up and you're looking at seasonal, you see the variety. You got blue lines down here. You got blue lines up here. It's all over the place. Versus something classic like Google, where, you know, you got one blue line down here, which of course is 08. But everything else is way up here. You know, so that's the kind of thing that just visually speaking, when you're looking at these charts, should jump out at you. So no, it was SNP because of the 90% probability, the good moves over the last few years, and the inexpensive option you can buy. One short I'm going to throw on here before we go, RBS. Royal Bank of Scotland. It's a tank. It's a 100%er. 7 out of 7 years. Let's take a look at that. Is it overbought right now? Boy, this thing's spotty all over the place. This is 1 year. 6 months, it's kind of in the middle, right at 50%. What did it do today? This thing gaps all the way over. It's like a staccato, you know, on a piano, music. You know, your music, what's that called? A music, not script, but, oh gosh, I used to do that. But anyways, you see what I'm saying? Royal Bank, again, I wanted to throw one short in there, 11.76. Make sure because defaultly opens up to calls, so just make sure you got to click show puts. Well, no. Why is it doing that? I'm going to have to tell Brett about that. That's not right. Okay, so it just messed all that up. No worries. This is, again, a beta version I'm using, folks, so don't be alarmed. It'll be fixed soon. RBS. What did I put? November 11s. That's back ratio. You could buy the 12.5. Look at that open end. You got a lot though, folks. There's a lot of people probably doing a straddle on this. Yeah, that's what people are doing. 34.89, 34.89. So if you wanted, it's $1.20, a little bit expensive to spend on an $11 stock, in my opinion. That's why I went just out of the money, not risk a lot. 11, 20 cents, folks. 20 cents and $11 stock, again, less than 1.5% premium. Some notable longs, again, we've already talked about Netflix, but I think it's worth bringing up again. Netflix, as Sonny pointed out to me, really doesn't start until after earnings. But a lot of people thought that was the trigger and catalyst of it popping. But if you really look at it, he's right. This starts, the green line, this is how I learned, and I should have recognized this. This green line starts after the green dots. It doesn't run, like look at MA. If I highlight MA, the green line starts before the green dots and runs right through. Versus Netflix, when you highlight the same area, it starts afterwards and goes up. So take a look at it. I've got that down. Mosaic is another one, even though it's has some negative rap, but that's a 90% to pop up. You look at best profit per trade. No, it's 80%. It's not that good. Wasn't a lot of seasonals now. 90%er. Last one is OI. Owens, Illinois. 92.31%. I'm not going to go through the math, but I've got the months and strike prices that I analyze. But please remember, everybody, as I wrap up with this, do your own due diligence, do your own math. These strike prices, expiration months, and everything I choose is based on last Friday's close. Market can change over the weekend as well as today. So readjust everything based on current calculations to make sure that you're picking the optimum strike price. All right, without any further ado, I'm